All right, this is our final video for Chapter 14. It's going to have a little bit of information on a second mortgage, which is what we call like a home equity loan. And also we'll do some things with qualifying ratios to kind of give you an idea if you would qualify for a conventional loan or an FHA loan. So this will be our last video for Chapter 14. All right, so let's talk about a home equity loan or line of credit, home equity line of credit. Basically, here's the deal. If you have equity in your home, you can borrow against it. A lot of people will borrow against it to do construction or to buy boats or new cars, and all of that would just roll back into their home mortgage. There is a pre-approved, though, credit limit on most home equity loans, and this is how we're going to find it. Method is called a percentage of appraised value. First of all, appraised value, the appraisal is the worth. How much is the house worth? Okay, so a percentage of the appraised value is how we determine what you can have as a potential credit. Okay, so you take your appraised value and you multiply that by the lender's percentage. Now that's going to be something that's already set in stone, the lender's percent. Okay, so your potential credit is going to be the percentage of appraised value minus your mortgage balance. You have to have a little bit of credit. You have to have some equity in your mortgage. And obviously, the more your mortgage is paid down, the more you're going to be able to borrow against it. It'll make more sense here when we do this first example. Terry Alexander owns a house that was recently appraised for $115,700. The balance on her existing mortgage is $67,875. So she has quite a bit of money there that she could borrow against it, okay? It looks like nearly $45,000 or so. All right, if her bank is willing to loan up to 75% of the appraised value, what's the potential amount of credit available for Terry to have on her home equity loan? Here's how this works. So first we need to find what 75% of the appraised value is. 115,700 times 75%, and that amount is 86,775. Okay, so they only let you borrow up to 75% of the original amount of the loan, or the value, the appraised value. So if she has 86,000 that she can borrow, but she still owes 67,875 on her first mortgage, so you got to subtract those to find the difference. The difference is 18,900. She can only borrow up to 18,900 on that line of credit or on that home equity loan. Okay, so just two steps. Figure out what percent we can borrow, what the amount is, and second step, subtract how much you have left on your first mortgage. Okay, the last thing that we're going to do is do qualifying ratios, and these are used by lenders to determine whether borrowers have the economic ability to repay loans. In other words, they look at this ratio to see, can this person borrow money and repay it, and do they have enough in their overall income to be able to do this. Okay, it's also called a housing expense ratio, the ratio of a borrower's monthly housing expense to the monthly gross income. Okay, so only a certain percent of your income can be considered to go towards your housing ratio. And then what you have is this total obligations ratio, the ratio of a borrower's total monthly financial obligations. So if there are car loans, if there's other types of fees, insurances, child support, whatever that is, there's another percent that we're going to find here. Okay, these 2% will control what kind of loan you can get, conventional or FHA. All right, the housing expense ratio is your monthly housing expense divided by the monthly gross income. And for total obligations ratio, it's your total monthly expenses, not just housing, but everything, divided by monthly gross income. Okay, now here are the percents that we are going to be looking at. Let's go to the housing expense ratio. So for an FHA loan, you have to at least have 29%. And for the total obligations for FHA, the percent that we're looking for is 41%. Okay, so if you fall within those, you can take an FHA loan. Conventional, a little more strict. The conventional housing expense ratio is 28%. And then for the total obligation, again, a little more difficult to get this, 36%. 36% of your income, if it is considered into that total obligations, then you could do a conventional loan. Let's just do one example here. Sue Harper earns a gross income of $2,490 per month. She has applied for a mortgage with a PITI of, that's principal, interest, taxes, insurance, of $556. Sue has other financial obligations totaling $387 per month. What is Sue's housing expense ratio? Well, her housing expense ratio would be, all we need to do is do that comparison. And so what's her housing expenses? It's $556. She's trying to get that loan. And her gross income is $2,490. This gives us a percent of 22.3%. Okay, let's do total obligations ratio. We need to take the 556 plus her other obligations, 387.50, and divided by the total of 2490. So the top is the total obligation, and this gives us 37.9%. So looking at these 2%, I'm going to go back to the ratios here. She's over the 36% for the conventional. So we have to fall within the FHA, 29% and 28%. She's lower than 29 and 28. Excuse me, not 28, 29 and 41 for the FHA. So that is what she is able to do, FHA. All right, what I want you to do is you got the two try it problems here, and go ahead and try those problems, and you can pause the video and I will go ahead and write those solutions down for you. All right, these are the results. You can see here that for that second mortgage, the person, Justin Schaefer, can borrow up to $41,880. And then on the last one here, these percents lie within the conventional percents. And that's it for this chapter. That's our last video for chapter 14.